All right, welcome to Talk Tickers. Today we are digging into the third quarter earnings for gambling.com Group. That's ticker GAMB. Now, this was a quarter that looked pretty good on paper. The market's reaction, though, whoa, that was a completely different story. Let's get into it. And there's the verdict. Down over 23% in a single day. The stock didn't just dip, it absolutely cratered, smashing through to a new 52-week low. And this all happened right after the company reported what seemed like a really solid quarter on the profit front. And that, right there, is the big mystery we're unpacking today. Gambling.com Group absolutely crushed its profit targets. So why in the world did investors basically hit the panic button and run for the exits? That is the question, and we're about to answer it. To really figure out why the stock plunged, we have to start with the headline numbers, because that's where all the confusion started. It's a classic Wall Street story, a beat on one thing, a miss on another, and the massive plunge that followed. Okay, so this table really tells you everything you need to know. On one hand, you've got this huge 60% beat on adjusted earnings per share. I mean, that's the good news if you're looking in the rearview mirror. But the market, its eyes went straight to the bad news. They missed on revenue, and this is the real killer. They took a knife to their full-year forecast. That guidance cut was the poison pill. The big takeaway here is that for a growth company like this one, what you say you're gonna do always matters more than what you just did. So to really get why they had to cut their guidance so hard, you kind of have to pop the hood and look at the engine, because Gambling.com isn't just one company anymore. It's really two completely different businesses running at the same time. One of them has stalled out, and the other one is just hitting ludicrous speed. And you can see it right here. Their old school business, marketing services, their affiliate websites, that's still the big piece of the pie, about 76% of all their revenue. But look at that other slice. The newer sports data business has ballooned to almost a quarter of the company. That is a massive change from just a year ago. And wow, this chart just lays it all out, doesn't it? It perfectly shows the problem and the big opportunity. The main engine, that marketing business, is totally flat, 0% growth. Nothing. Meanwhile, the new data engine is just exploding, up over 300%. So this isn't just a little slowdown, folks. This is a huge strategic shift happening right inside the company, and the market is scrambling to figure out what it all means. So you're the CEO. Your core business has flatlined. What do you say? Well, management came to the earnings call with a very specific story they wanted to tell. They framed this whole slowdown not as some internal crisis, but as a short-term problem caused by something outside their control. And here's the money quote from the CEO, Charles Gillespie. He's blaming temporary search dynamics. Now, that's just corporate speak for Google changed its search algorithm and it's messing with our traffic. He's basically saying Google is promoting a bunch of spammy, low-quality sites right now. But the key word here, the one he wants investors to hear, is temporary. He's signaling, hey, this is fixable. It's not a permanent flaw in our business. So management laid out a four-part argument to calm everyone down. First, this whole Google SEO thing is just a temporary headache. Second, they're already moving away from relying so much on Google anyway. In fact, they said they expect to make more money from non-Google channels than Google for the first time ever next quarter. Third, they pointed to the future, which is all about that super high-growth, high-margin sports data business. And finally, they said, we're putting our money where our mouth is, and announced they're buying back almost $5 million worth of their own stock. Because in the CEO's own words, the current price is simply wrong. So that was the story management was selling. A temporary problem, a bright future. The issue? The market heard that story, looked at the guidance cut, and just wasn't buying it. Not even a little. The reaction was swift, brutal, and it screamed a total crisis of confidence. And this slide really nails the two competing narratives. Management wants you to focus on the temporary SEO issues and get excited about the long-term data growth. But the market? The market saw something totally different. It saw a huge risk in their main business and decided that the only thing that really mattered was that very real, very painful cut to their forecast. And look, it wasn't just nervous day traders. The pros on Wall Street ran for the hills too. You had analysts immediately slashing their price targets. Stifel cut their target to $12, Truist went down to 7, Jefferies to 13, Macquarie to 9. The message was loud and clear. Nobody was willing to give them the benefit of the doubt that this SEO problem would get fixed quickly. And if you need any more proof of just how serious the market was, just look at the trading volume. They traded almost 7 million shares on earnings day. Their normal daily average? Around 200,000. That massive spike, that's not just noise. That's a giant flashing red light that says institutional investors, the big money funds, were dumping the stock, and they were dumping it hard. Okay, so we've got management telling one story and the market screaming a completely different one. So where do we land on all this? In this last section, we're going to put it all together and give you our forward-looking take and rating on gambling.com Group. So you can really make a case for both sides here. The bull case is pretty simple. That data business is growing like a weed, the company still makes a lot of cash, and hey, management is buying back its own stock. But the bear case, well, it's pretty powerful. You've got this giant cloud of uncertainty over their main business. Their profit margins are getting squeezed, and the stock is just getting left in the dust by its competitors. So what happens from here? Well, our prediction is that this stock is officially in the penalty box. It's probably going to trade sideways, stuck in a range until the company delivers one thing, and one thing only: proof. Not promises. We're talking hard numbers, clear data that shows these Google problems are over and that their core marketing business is actually growing again. So because this has become such a show-me story, we're initiating our rating on GAMB at market perform. Basically, the huge risk in their marketing business is being balanced out by the big opportunity in their data business. That suggests the stock is probably just going to move in line with the overall market until we see a real reason for it to break out one way or the other. This is not financial advice.